welcome to Griffonomics.
Glad to be here.
So, imagine for a second that you're holding the master blueprints to the entire artificial intelligence revolution.
Right.
Like you are essentially the only thing keeping the lights on for the next generation of Amazon and Google data centers.
Yeah, which is no small feat.
No, exactly. And, your software maps out all of the electric grid's vulnerabilities. Your engineers build the hardware to fix those exact vulnerabilities. And then literally just last week, the White House comes out and declares your specific industry a matter of national defense.
A literal national defense priority.
Right. So you're writing this unprecedented waves of federal tailwinds. But then, and this is the crazy part, you look at the stock market and Wall Street just cut your company's value in half.
Yeah, it really is the ultimate diagnostic puzzle in modern finance right now.
It makes no sense.
Well, I mean, you have algorithms, right? Algorithms and short-term traders reacting violently to it is basically a completely misunderstood accounting quirk.
Just a quirk.
A quirk. But in the process of panicking over that, they are completely ignoring this massive structural regime change that's happening right underneath their feet.
And that paradox is really the core mission of today's deep dive.
Absolutely.
We have this absolute mountain of analyst notes, corporate filings, strategic reports, and historical timelines today. And it's all centered on one specific company.
Willdan Group.
Right, Willdan Group, trading under the ticker WLDN.
Yep.
Today, we're going to unpack how this, traditional municipal consulting firm, a company that honestly used to just help cities figure out their zoning or like basic civil engineering.
The traditional stuff.
Yeah, how they're actively transforming into what analysts are now literally calling a neoprime national defense asset.
Which really sets the stakes for you listening right now.
Exactly.
Because whether you're an investor, hunting for an asymmetric rebound in the market, or if you're just somebody trying to understand the actual physical realities of this AI power bottleneck that everyone keeps talking about.
Which is everywhere in the news.
It is everywhere. But Willdan is the perfect case study for it. I mean, they possess a massive $1 billion funded backlog.
Billion with a B.
Yes, with a B. And yet they're trading at this massive discount purely because of a technicality.
Right. But to understand that technicality, we first really need to understand the actual machine here.
Yeah, what they actually do.
Exactly. We need to look at what Willdan does in 2026 because, if you rewind a decade or two, civil engineering was very much about physical execution.
Pouring concrete.
Right. You drew up plans for a dam, and then you owned the bulldozers that built the dam. But Willdan, they completely flipped that script.
They did. They realized that the real leverage, the actual bottleneck in modern infrastructure isn't pouring the concrete.
Right.
It's the complex power engineering. It's policy advisory and electric load forecasting. So Willdan shifted their entire operation upstream.
Yeah.
They became a tech-enabled grid guardian rather than, a traditional construction crew.
So let's visualize that upstream shift for a second. What does that actually look like in their day-to-day operations?
Sure.
Because, running a massive infrastructure company usually means you have thousands of union laborers, massive equipment yards, and just terrifying overhead costs.
No,
right.
Massive overhead. But they avoided all of that by adopting a highly sophisticated staff augmentation model.
Okay, staff augmentation, meaning what exactly?
Meaning instead of maintaining this bloated internal payroll of construction workers and heavy machinery, Willdan focuses almost entirely on high-level intellectual property.
Got it.
They employ the data scientists, the top-tier electrical engineers, and the regulatory experts. Those are the people who design the complex grid blueprints and manage the municipal relationships.
I see. So they handle all the intellectual heavy lifting.
Precisely. And then, when it actually comes time to string the wires or pour the foundation, Willdan pays out roughly 46.5% of its contract revenue to external subcontractors.
Wow, almost half.
Yeah, they farm out the actual physical execution.
Okay, so if I'm building a house, Willdan isn't the guy showing up with the hammer.
No.
Willdan is, they're like the general contractor.
That's a great way to put it.
They're the high-function architectural brain. They design the layout, they secure the permits from the city, they tell the plumbers where the pipes need to go, and then they just hire out the actual plumbing work.
That is a highly accurate way to frame it.
Yeah.
And by keeping their internal headcount focused solely on engineering and data analytics, Willdan can go out and bid on massive $100 million mega projects.
Right.
Without absorbing the fixed overhead that historically just crushes traditional construction firms the second an economic downturn hits.
Because they don't have all that heavy machinery sitting idle.
Exactly. They stay incredibly nimble.
But wait, let me push back on that a little bit.
Sure.
Because relying that heavily on subcontractors, it sounds great on paper, but doesn't that open them up to massive external risks?
It definitely introduces a different risk profile, yeah.
Right, because we've all seen construction costs, raw materials, and specialized labor rates absolutely skyrocket over the last few years.
Oh, completely.
So if Willdan is routinely paying out almost half of their revenue to outside crews, aren't they incredibly vulnerable to getting squeezed? Like, if the cost of a specialized union electrician doubles, Willdan's margins should theoretically just evaporate, shouldn't they?
That is the exact vulnerability that keeps risk managers up at night.
Yeah, I would think so.
Because if inflation runs hot and third-party labor costs spike, a general contractor usually eats the loss on a fixed-price contract.
Right.
However, Willdan mitigates this squeeze by embedding themselves deeply into the long-term regulatory frameworks of their clients.
Okay, what does that mean in practice?
Well, they don't just bid on one-off jobs. They sign multi-year master service agreements, and those almost always include inflation escalators.
Ah, okay. Built-in protection.
Exactly. And
Yeah.
because they are the ones actually writing the policy and designing the compliance roadmap for these municipalities, they inherently possess incredible pricing power.
They hold the keys.
They do.
And looking at our stack of research here, a massive driver of that pricing power actually comes from state and local legislative policies.
It's a huge driver.
Like, the analyst notes are just filled with references to decarbonization mandates, energy efficiency regulations, municipal greenhouse gas reduction targets, all that stuff.
Right.
Now, just to be crystal clear for you listening right now, we are going to analyze these environmental policies strictly from an impartial operational perspective today.
Right. Strictly the business impact.
Exactly. We are not here to endorse or critique the politics behind local climate mandates. We are simply reporting the reality that these state and local policies exist. And, well, they basically serve as the fundamental structural bedrock of Willdan's current business model.
Yeah, and from a purely economic standpoint, a legislative mandate is the ultimate demand generator.
I mean, you legally have to do it.
Right. When a massive economy like California or New York legally mandates a shift to a lower carbon grid, they essentially create a captive market for Willdan's advisory services.
Oh.
A city manager suddenly faces this legal requirement to overhaul their entire energy infrastructure by 2030, and they simply do not have the internal expertise to do it.
They don't have the engineers on staff.
No, of course not. So they have to hire a Willdan.
So Willdan positions itself as the strategic brain, helping these massive bureaucracies navigate their own mandates.
Exactly.
But as we all know, you can't really manage the modern electric grid with a clipboard and an Excel spreadsheet anymore.
No, absolutely not.
The complexity is just way too high. So this is where the story kind of pivots from municipal consulting into deep technology.
This is the really fascinating part.
Let's dig into the software moat they've built. Specifically, their proprietary platform called LoadSeer.
LoadSeer is the crown jewel of Willdan's technological portfolio.
Crown jewel.
It really is. It completely separates them from legacy consulting firms. In technical terms, it is a proprietary spatial forecasting tool.
Okay.
And right now, it is embedded in the operations of over 100 utilities across the United States, including massive, complex networks like Pacific Gas and Electric.
PG&E.
Right.
So break down spatial forecasting for us. Like, what exactly is PG&E using LoadSeer to see?
So the software acts as a hyper-advanced predictive radar for electricity.
Predictive radar.
Yeah. It takes decades of historical weather patterns, demographic growth data, and it merges that with something called SCADA data.
SCADA. SCADA, right. What is that?
Right. Supervisory control and data acquisition.
Okay.
Think of SCADA as the digital nervous system of the power grid. It's the raw, real-time data streaming from thousands of physical sensors located on transformers, substations, and power lines.
Oh, so literally the pulse of the grid.
Exactly. And LoadSeer feeds all of this into an AI-enabled analytics engine to forecast exactly where the physical grid is going to buckle under the stress of new electric loads. And it does this down to the specific city block.
Wait, down to the block.
Down to the block.
Okay, so this brings up something from the notes. I saw the term data gravity.
Yes.
Now, I usually hear data gravity in the context of cloud computing, right? Like where Amazon, AWS, or Google Cloud makes it technically and financially excruciating to move your company's data over to a competitor.
Right, they lock you in.
Exactly. Are you saying Willdan is using software to trap physical utility monopolies in the exact same way?
It's the exact same mechanism.
Wow.
Consider the daily reality of a utility grid planner. Once you integrate Willdan's load-seer analytics into your core operations, once it becomes the foundational layer of truth for your 10-year grid expansion plans,
Yeah.
the operational risk of switching to a different software provider becomes terrifyingly high.
I can imagine.
You do not just rip out the central nervous system of your city's power forecasting just because another consulting firm comes along and offers a slightly cheaper hourly rate.
Right, because if the new software miscalculates the load by even a fraction,
You cause a catastrophic blackout.
right, the stakes are simply too high.
Exactly. That ingrained reliance creates this massive, almost impenetrable moat around Willdan's utility contracts. It's classic SaaS stickiness, but applied to physical, critical infrastructure.
Software as a service stickiness for the real world.
Exactly.
And according to the filings, Willdan isn't just selling AI software, right? They're actually eating their own cooking internally.
They are, yeah.
Like, the reports detail Willdan's internal adoption of large language models, LLMs, to reduce their own administrative burdens.
Yeah, which is incredibly smart. By using internal LLMs to parse these incredibly complex 1,000-page municipal building codes or to shoulder heavy IT integration tasks, Willdan essentially automates the bureaucratic grunt work.
The boring stuff.
The very boring, time-consuming stuff. And this frees up their human electrical engineers to focus entirely on the high-value, high-margin strategic decisions.
Right.
It compounds the efficiency of that staff augmentation model we discussed earlier.
Okay, so I want to connect a couple of dots here.
Sure.
We have LoadSeer acting as this incredibly sticky predictive radar for the grid, right?
Right.
It's like Waze for the electric grid.
That's a great analogy.
It spots the exact intersection where a transformer is going to catch fire because a new hyperscale data center is trying to plug in.
Exactly.
And here's the catch radar doesn't actually fix the air claim.
No, that doesn't.
Right. It just tells you there's a problem. So if Willdan is so obsessed with staying asset light and avoiding the physical construction, who is actually pouring the concrete and building the massive hardware upgrades that these tech giants so desperately need?
That is the exact strategic gap Willdan realized they had to fill.
Ah.
Which brings us to their physical execution arm,
Yeah.
the Alternative Power Generation Subsidiary, or APG.
APG.
Right. Which Willdan strategically acquired in March of 2025.
Okay, but this feels like a massive pivot, though.
It is a pivot.
Like, we literally just spent the first 20 minutes talking about how their entire competitive advantage was based on avoiding physical execution to protect their margins.
Right, but it's a highly targeted pivot. They aren't going back to pouring asphalt for local sidewalks.
Okay.
APG transitions Willdan from merely pointing out grid bottlenecks to providing what they call concept-to-concrete grid interconnection solutions.
Oh, concept to concrete. Catchy?
Very. And they are targeting one highly specific, incredibly lucrative demographic, hyperscale AI data centers.
The Googles, the Amazons, the Microsofts.
Exactly. APG is actively designing and managing the construction of the massive, complex electrical substations required to plug these data centers into the broader grid.
Wow.
To give you a concrete example from the sources, Willdan is currently executing a $38 million interconnect substation project in Phoenix.
$38 million just for one project.
For one interconnect. And it's for Menlo Digital, a major data center developer. They're also doing direct consulting and siting optimization for Amazon.
$38 million just for the interconnect in Phoenix.
Yeah.
Now, just to be clear for the listener, an interconnect isn't just like a big extension cord.
No, not at all.
We are talking about massive industrial facilities, right? They take ultra-high voltage power, say 345 kilovolts, coming off a massive transmission line, and they step it down, condition it, and distribute it safely into the server racks without completely frying the equipment.
Exactly. It's a massive undertaking. And the demand for these interconnects is experiencing a violent upward trajectory right now.
Violent is a good word for it.
The analyst reports highlight this shocking historical metric. For the last 15 years, total electric load growth in the United States was effectively flat.
Flat. Really?
Completely flat. We became more efficient with LED lighting and better appliances, so our overall power usage stagnated.
That makes sense.
But suddenly, the generative AI boom has ended that stagnation literally overnight.
Because the numbers in this report are just staggering. 35 gigawatts of active data center construction currently underway in the U.S.
Yes, 35 gigawatts.
Like, to put that in perspective, how much is 1 gigawatt?
So to contextualize 35 gigawatts, a standard nuclear power plant reactor produces roughly 1 gigawatt.
Oh my God.
So we are talking about the equivalent of 35 nuclear reactors worth of energy demand coming online almost simultaneously.
That's insane.
It is. And because Willdan's APG division sits right at the physical bottleneck of this demand, management expects the revenue from this specific segment to more than double in 2026.
Okay, and this is where I really have to challenge the premise here.
Go for it.
Designing a state-of-the-art substation for an Amazon data center sounds like a license to print money.
It does.
But historically, anything touching the power grid is an absolute bureaucratic nightmare.
A cold nightmare.
Right. You can design the perfect interconnect facility, but doesn't it usually take 3 to 5 years for state regulators, environmental boards, and local utility commissions to actually approve the physical plug-in?
Usually, yes.
So how can Willdan project their APG revenue to double next year if these massive projects are historically stuck in regulatory purgatory?
Well, you have correctly identified the historical friction point.
Okay.
That exact regulatory lag is why Wall Street has traditionally suppressed the valuations of engineering firms in this sector. It took years to convert a backlog contract into actual recognized revenue.
But
That entire paradigm was shattered just a week ago.
April 20, 2026.
Exactly.
This is where the story goes from municipal infrastructure to literally national security.
It really does. The White House officially invoked Section 303 of the Defense Production Act, commonly known as the DPA.
Okay, let's dissect this very carefully, maintaining our strict political impartiality here.
Of course.
We are analyzing this DPA invocation purely as a structural catalyst for Willdan's business operations.
Exactly.
What exact lever did the White House pull?
So the executive memorandum officially declared that America's domestic grid infrastructure, specifically advanced conductors, transformers, and the physical components of substations, are now legally classified as essential to the national defense.
Right, they literally made transformers a defense issue.
Yes. And crucially, the memorandum explicitly linked this emergency designation to the massive, unforeseen energy demands of emerging artificial intelligence technologies.
They classified the AI power bottleneck as a direct threat to American national security.
They did. And the implications of that classification create what financial analysts call a defense multiplier.
Defense multiplier.
Right. By invoking the DPA, the federal government instantly stripped the discretionary label off of grid modernization projects.
Meaning upgrading a substation is no longer just a nice-to-have municipal project that a city council can debate for 3 years.
No, it is a mandatory defense priority.
Wow. So what kind of financial toolkit does that unlock for a company like Willdan?
It unlocks the most powerful financial engine on the planet, the U.S. Treasury.
Oh, wow.
Under Section 303, the Secretary of Energy is now authorized to bypass traditional sluggish capital markets entirely.
Skip the line.
Skip the line entirely. They can provide government-backed financing guarantees, they can execute direct federal purchases of grid components, and they can sign long-term purchase commitments.
So they don't have to wait for the local bond measures to clear.
Exactly. Willdan is no longer just a cyclical engineering firm dependent on the fluctuating tax revenues of local cities. They have been structurally elevated.
Yeah.
They are now operating as a federally backed, neoprime defense industrial asset.
That is a wild transition. But what about the regulatory red tape we talked about? The 3 to 5 year wait times?
Addressed simultaneously.
Really?
Yes. In parallel with the White House DPA invocation, the Department of Energy directed the Federal Energy Regulatory Commission, or FERC, to initiate emergency rulemaking. Historically, FRRC left interconnection approvals up to a highly fragmented, chaotic state-by-state process.
Which is why it took 5 years.
Exactly. But the new DOE directive proposes expanding FRC's federal jurisdiction to enforce a highly expedited 60-day time frame for specific AI data center interconnection studies.
60 days.
60 days.
Going from a multi-year waiting game down to 60 days is, that's light speed in the utility sector.
It's completely unheard of. And it fundamentally alters the velocity of capital for Willdan.
Because they can start building immediately.
Right. By legally slashing the regulatory red tape, this federal mandate unclogs the APG revenue pipeline, It allows Willdan to convert that massive backlog of hyperscaler interconnect projects into recognized top-line revenue at a pace the market has never seen before.
All right, I'm genuinely baffled at this point.
I don't blame you.
Let's recap the reality we've just established here. You have a company with a wildly sticky predictive AI software moat in LoadSeer. You have a physical execution arm in APG that is currently building multi-million-dollar substations for the biggest tech companies on Earth.
Right.
You have an unprecedented 35 gigawatts of active data center construction driving demand.
Massive demand.
And to top it all off, the federal government just handed them a defense financing blank check and slashed their regulatory waiting period down to 2 months.
The macroeconomic setup is arguably flawless.
Then how is this possible? Why on earth is Willdan's stock down nearly 50% since January?
And here is the paradox.
Like, you look at a stock chart, and it looks like the company is going bankrupt. How does a defense-backed, AI-adjacent monopoly lose half of its market capitalization in 4 months?
This is where we transition from engineering reality into the dark arts of corporate accounting.
Oh, boy.
To understand why the algorithms triggered a massive sell-off, we really have to look at how Wall Street blindly screams for surface-level financial health.
Right.
And how they completely misread a massive accounting distortion known as the Section 179D earnings cliff.
Section 179D. This is the tax code legislation mentioned repeatedly in the filings.
Yeah.
What is the mechanism here? How does a tax code crash a stock this hard?
So the Section 179D energy-efficient commercial buildings deduction was a highly generous piece of federal tax legislation designed to incentivize green building practices. Here is how the mechanism works. Willdan acts as the primary designer for massive, energy-efficient public buildings, things like schools, courthouses, city halls.
Makes sense.
Now, municipal entities like a public school district do not pay federal income taxes.
Right. A school district doesn't file a corporate tax return.
Exactly. Therefore, a tax deduction is absolutely useless to them.
Oh, I see where this is going.
So, to ensure the incentives still worked, the law allowed these municipal tax-exempt clients to legally transfer or allocate their earned tax deductions directly to the private firm that designed the efficiency upgrades.
They allocated them to Willdan.
They allocated them to Willdan.
Wow. So Willdan gets to claim massive federal tax deductions for the efficiency of the buildings they are designing for the government. They're essentially harvesting the tax credits the government couldn't use.
It was incredibly lucrative. This allocation mechanism allowed Willdan to achieve a massive negative 31.4% effective tax benefit in fiscal year 2025.
Wait, a negative 31% tax rate?
Yes.
They weren't just paying zero taxes. The tax code was actively paying them to exist.
Yes.
I mean, who is their accountant? I need their phone number immediately.
Right. It was a massive non-cash boost to their reported bottom line. It artificially inflated their earnings per share, or EPS.
Ah, artificially inflated.
Exactly. However, legislative tax deductions do not last forever.
Of course not.
The enhanced rates and specific allocation rules under Section 179D are legally scheduled to expire, or sunset, in June of 2026.
Ah, the cliff.
The earnings cliff. Because of this impending legislative expiration, Willdan's accounting department has to normalize its forward-looking tax assumptions.
Right, they have to tell Wall Street what's coming.
Exactly. So they are guiding Wall Street to expect a standard corporate tax rate of roughly 10% in 2026.
So they go from a negative 31% tax rate in 2025 to a positive 10% tax liability in 2026.
Exactly.
That is a brutal swing on the balance sheet.
It drastically alters the optics of their profitability. Because of that massive swing in the tax column alone, their bottom line adjusted EPS for 2026 is guided down to between $4.50 and $4.70.
Okay, so their EPS drops.
Now, put yourself in the shoes of a quantitative trading algorithm.
Right.
The algorithm doesn't read the nuance of legislative tax sunsets. It simply scans a database for year-over-year EPS growth.
And the algorithm sees the EPS shrinking, assumes the underlying business is contracting, and just initiates an automated sell order.
The algorithms panicked, and then human traders followed suit. This triggered a massive 50% stock sell-off. The valuation multiples compressed violently. The forward price-to-earnings ratio, the PE, reset from a sky-high 32x down to roughly 17.3x.
Let me see if I can translate this accounting quirk into like a real-world scenario for the listener.
Sure.
Because the situation is basically like getting a massive one-time tax refund check in the mail one year and you feel incredibly rich.
Right.
And then the very next year, you cry because you just get your regular standard paycheck, even though you actually got a massive promotion and a 10% raise at your actual job.
Exactly.
If you only look at the bottom line cash in your pocket year over year, it looks lower. But your actual structural earning power went significantly up.
That is an exceptional analogy. The tax refund basically distorted the reality of the promotion.
Right.
To prove that Willdan's underlying business is actually thriving, we have to look past the distorted earnings per share metric.
What should we be looking at instead?
Analysts prefer to look at enterprise value to EBITDA, which dropped to a highly attractive 13.5x. But more fundamentally, we just need to examine their raw operational cash flow and their contract backlog.
Okay, let's do exactly that. Let's strip away all the Section 179D tax noise and look at the fundamental operational reality of their 2025 financial review.
Okay.
If we ignore the tax credits entirely, how is the actual business performing?
The operational reality is that 2025 was a record-breaking fortress year for Willdan.
Really?
Net revenue hit $364.8 million. That represents a 23% year-over-year organic growth rate.
23% organic growth for a legacy engineering and infrastructure firm, that is almost unheard of. That is tech sector growth.
It's phenomenal. But more importantly, if we look at adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization.
Right, the metric that ignores taxes.
Exactly. This is the crucial metric because it explicitly ignores the tax distortion we just spent 10 minutes discussing.
Okay, so how did EBITDA do?
Adjusted EBITDA grew by an astounding 40%, hitting $79.5 million.
Wow. So the core operational profitability of the actual work they do grew by 40%, even while the stock price was being cut in half because of a tax sunset.
The market dislocation is staggering.
It really is.
Furthermore, their operational efficiency improved drastically. They achieved a 21.8% EBITDA margin.
Oh, wow.
Which is huge because it successfully broke through the long-term 20% margin target that management had been chasing for years.
So they're more profitable than ever.
Yes. And perhaps most critically for their long-term stability, Willdan achieved a net cash position of $17 million for the first time in over a decade.
Meaning they are no longer burdened by debt.
Zero net debt.
They literally have more cash sitting in the bank than they owe to creditors. The filings actually note they generated $71 million in pure free cash flow.
That is the definition of a fortress balance sheet.
But, you know, a strong balance sheet today doesn't guarantee survival tomorrow.
Fair point.
Let's look at the future. The company boasts a $1 billion backlog. But let's be honest, a backlog is only as good as the paper it's printed on if a severe recession hits and clients start defaulting left and right.
True, but the quality and composition of Willdan's backlog is what makes it so uniquely resilient.
How so?
This is not a speculative pipeline. It is a $1 billion funded backlog. Crucially, roughly 89% of Willdan's total revenue comes directly from government entities and regulated utility budgets.
Oh, 89%, which means their revenue is entirely decoupled from cyclical commercial spending.
Exactly.
Like if there's a commercial real estate crash, Willdan doesn't care.
They're completely insulated. Their contracts are funded by non-discretionary, voter-approved municipal bonds and legally mandated utility ratepayer funds.
Right, the money is already set aside.
To put it bluntly, everyday citizens do not stop paying their electric bills during a recession, and city governments cannot easily cancel voter-mandated infrastructure bonds without severe legal and political repercussions.
The revenue is essentially locked in.
Completely locked in.
Let's get granular here. What do these mega contracts actually look like? What makes up this billion-dollar fortress?
Sure.
Because the sources highlight several massive operational wins secured in early 2026 alone.
The velocity of their 2026 contract awards is really remarkable. Let's look at their $112 million contract with the city of San Diego.
Okay, $112 million.
This is a massive multi-tiered project. Willdan is tasked with implementing energy and water efficiency measures across 40 different city-owned facilities, completely decarbonizing 23 municipal buildings, and most impressively, upgrading 39,000 city-owned streetlights.
Wait, $112 million. What exactly goes into upgrading 39,000 streetlights to justify that cost? Are they just screwing in LED bulbs?
Far from it.
Okay.
They are transforming passive municipal infrastructure into active, decentralized power assets.
What does that mean?
they're integrating solar collection infrastructure and localized battery storage directly into the streetlight networks.
Really? Into
Yeah.
the streetlights?
Yes. It essentially turns the city's lighting grid into a self-sustaining microgrid that can operate independently during broader power failures.
Oh, wow.
It is highly complex engineering.
Incredible. What else is in the backlog?
Well, there is a $97 million energy and infrastructure upgrade for Alameda County,
Huge.
a $49 million distributed energy and resiliency project from San Antonio College, ensuring the campus remains operational during regional blackouts.
Right.
And finally, a highly strategic $27 million contract to completely redesign and implement the New York City Accelerator Program.
Ah, the NYC Accelerator. That has to be tied to local law 97, right?
Exactly.
For listeners unfamiliar, New York City passed one of the strictest building emissions laws in the world, threatening massive commercial skyscrapers with millions of dollars in annual fines if they don't drastically cut their carbon footprint.
That is the exact driver.
Yeah.
Willdan is partnering with 8 specialized local firms to shift the NYC Accelerator Program away from mere energy awareness and toward aggressive physical project implementation.
So actually fixing the buildings.
Right. Willdan is providing the engineering blueprints to help these massive commercial building owners retrofit their HVAC systems, upgrade their insulation, and integrate smart grid tech.
All to legally comply with the new greenhouse gas regulations and avoid those crippling fines.
Precisely.
Okay, this all sounds incredibly solid. $1 billion in non-discretionary, federally and municipally backed backlog.
It's a very strong position.
But I have to play devil's advocate here.
Go ahead.
Are there any hidden cracks in this fortress? Because deriving 89% of your revenue from government and utility contracts is fantastic for macroeconomic stability. But doesn't it also mean all your eggs are sitting in just a few massive, highly bureaucratic baskets?
Yes, it does.
Like, what happens if a political regime changes and a massive client just abruptly pulls the plug?
You have correctly identified the primary structural risk that objective financial analysts are laser focused on, and that is intense customer concentration.
Let's look at the numbers. How top-heavy is Willdan's revenue stream?
In fiscal year 2025, Willdan's top 10 clients accounted for over 50% of their consolidated contract revenue.
Half of their entire business relies on just 10 phone calls going well.
Basically,
That is nerve-wracking.
the concentration gets even tighter.
Oh, no.
Just 2 specific clients, the Clark County School District in Nevada and Southern California Edison, made up over 23% of Willdan's total revenue.
Over a fifth of the entire company relies on one school district and one regional utility.
Yeah, the Clark County project is an absolute behemoth. Willdan is solely responsible for lighting replacements, advanced HVAC controls, and comprehensive energy audits across over 200 individual schools.
Wow.
We're talking covering more than 23.7 million square feet of public infrastructure.
That is massive.
It is. Now, almost all standard government contracts contain what is known as a termination for convenience clause.
Meaning what?
This means the government can cancel the contract at virtually any time for almost any reason without proving a breach of contract by Willdan.
Oh.
So if Clark County underwent a drastic political shift and invoked that clause, or if Southern California Edison found a cheaper vendor, it would be devastating to Willdan's immediate profitability.
That's a huge risk. And what about external competition?
Also a major factor.
I mean, if the federal government is suddenly handing out massive Defense Production Act guarantees for grid infrastructure, aren't the massive global engineering firms going to want a piece of that pie?
Oh, absolutely.
Why wouldn't a Titan just step in and crush Willdan?
It is a highly legitimate threat. Willdan operates in a very specific mid-tier niche. They sit squeezed between high-level tech strategy consultants like McKinsey and massive global primes.
When we say global primes, we are talking about mega corporations like AECOM, Jacobs Engineering, or Quanta Services.
Exactly. These are the behemoths that build international airports, global pipeline systems, and massive military bases.
Right. They have practically infinite money.
They possess almost limitless capital. Now, Willdan actively tries to differentiate itself by staying nimble and maintaining that load-sear software lock-in we discussed earlier.
Saw stickiness.
Right. But the risk is that these massive global primes could decide to aggressively expand into the grid edge space.
Oh, and just buy their way in.
Exactly. They could utilize their massive economies of scale and their superior margin buffer to aggressively underbid Willdan on new, federally backed AI infrastructure contracts. simply to buy market share.
They'll take a loss just to starve Willdan out.
That is always the fear when you're swimming with the whales.
Okay, so synthesizing all of this, we have to objectively weigh the very real customer concentration risks and the looming threat of deep-pocketed global primes against the incredibly depressed current valuation of the stock.
Right. It's a balancing act.
Based on the comprehensive strategic report in our sources, what is the final verdict from the financial analysts?
The consensus strategic outlook for Willdan Group is definitively rated as an asymmetric rebound.
Asymmetric rebound. Let's break down that specific financial phrasing. Why asymmetric?
An asymmetric bet means the potential upside vastly outweighs the potential downside.
Okay.
In Willdan's case, the downside risk is largely already priced into the stock. As we noted, the forward PE multiple has already violently compressed from 32x to 17.3x.
So the damage is already done?
Exactly. The algorithmic panic over the Section 179D tax cliff has already occurred. The bad news is out in the open, and the market has already issued its punishment.
The blood is already on the streets, so to speak. For the stock to fall further, the company would practically have to implode.
Yeah, to justify further downside from this level, Willdan's organic growth would have to permanently stall at around 7%. Their hard-fought margin expansions would have to plateau and reverse, and the broader risk-off market sentiment regarding municipal spending would have to persist indefinitely.
Which seems unlikely given the backlog.
Highly unlikely. Meanwhile, the upside catalysts, the unprecedented AI data center supercycle, the 35 gigawatts of active construction demand, and crucially, the DPA federal defense mandate are virtually ignored by the current depressed share price.
They aren't pricing in the good news at all.
Not at all.
So, to summarize the core thesis for you listening today, you are looking at a company that appears like a falling knife on a surface-level stock chart purely because of a temporary legislative accounting glitch.
Right.
But underneath that technical glitch, the financial reality is masking a structurally reinforced, federally backed growth engine sitting directly at the geographic and technological center of the greatest power bottleneck in modern history.
That's the core of it. It is the story of a company that successfully executed a fundamental transition. They evolved from a cyclical, localized civil consultant into a legally protected neoprime asset.
Which leaves us with one final, incredibly provocative thread to pull from these filings before we wrap up today.
Oh, the activist angle.
Yes. We established earlier that Willdan achieved a net cash position of $17 million. They generated $71 million in pure free cash flow, and they have effectively zero leverage holding them down.
A pristine balance sheet with zero debt overhang.
And according to the final pages of the corporate filings, management just quietly expanded their bank credit facility.
They did?
They increased their borrowing capacity from $150 million up to $200 million. They have a massive war chest of dry powder just sitting there.
They are heavily armed with capital.
So here's the scenario for you to mull over as we end this deep dive. Willdan's stock is currently trading at a steep, algorithm-driven discount due to the misunderstood tax cliff.
Yep.
Yes, they have corporate defense mechanisms in place, strict advance notice procedures, staggered boards, and the protection of Section 203 of the Delaware Corporate Code. But history shows that value investors are ruthless.
Very ruthless.
The sources note that a group called Forager Fund already built a massive 14.2% stake in Willdan back in 2023, successfully forcing changes before taking profits.
There is a precedent.
Exactly. With the stock currently beaten down and the company sitting on a mountain of cash and expanded credit, will a new activist investor swoop in right now?
It's the multi-million-dollar question.
Will an activist hedge fund acquire a massive stake and force Willdan's management to execute massive share buybacks? Essentially, will Wall Street insiders use this temporary accounting glitch to scoop up this newly minted defense industrial asset at bargain basement prices, consolidating their ownership right before the rest of the market wakes up to the DPA reality?
Given the pristine balance sheet and the depressed valuation, an activist intervention is a highly plausible near-term scenario.
It makes too much sense.
It really does.
Yeah.
The gap between the market's algorithm-driven perception and the federally backed fundamental reality is simply too wide and too lucrative to ignore for long.
The muddy waters of diagnostic finance. Sometimes you have to look past the broken X-ray machine of standard EPS to see the indestructible structural skeleton underneath, risk-defined, portfolio protected,